Hello everyone, my name is Boyan, and for those of you that don't know me, I am a moderator in the Discord, and also I have helped Jay create this course, and I will be adding some lessons to it, starting with swing failure patterns. So today we will talk about what is an SFP, or as Jay likes to call them, chickens drinking water, where does it occur, why does it occur, and then how can we trade it. So swing failure patterns is just essentially price wicking above a certain high or a certain low. Like in this example, on the 27th of December, we have price ranging for a couple of days and then its swing failure pattern, the high, so it wicked above, closed below, and then price dropped and has been dropping since then. Another example is this, where price came down, took all of these lows, closed back above, and then continued to the upside. And we have this one as well. So you can see we have a lot of these happening. So this is the high, price went down, took out these lows, closed back above, came back above for these highs, took them out, closed, and then continued ranging. So you can see on the outside is a pretty simple concept. It can happen on all time frames from the 1 minute all the way to the monthly. And to give examples, I know of Ethereum versus Bitcoin on the weekly. So you can see here price ranging. This asset has been ranging for um, almost 400 days. And here at the top of the range, we actually SFP'd these highs, and then you can see how price goes above the wick, closes below it, and then continues to the downside. Also, another example I can give you is on the DXY right now on the monthly. So you can see we have been in this range or channel for now almost 300 days, 3000 days, and we SFP'd these highs. It's still not confirmed because the month closes in 2 days, so it can always do this and not be an SFP, but it has like 2 days in order for price to pump up and for this not to be an SFP. So you can see it happens on the monthly, and then I can give you some quick examples on Bitcoin on like the 5 minute, for example. So this right here, a wick, a high, excuse me, and price wicks above it, closes below, and then has a drop of almost 1%. And this happens all the time. For example, here as well, a high, wicks above it, closes back, and then continues to the downside. So these happen a lot on the 5 minute, and as with everything in trading, the higher the time frame, usually the bigger the outcome. And these on the 5 minute don't mean much, and you wouldn't expect a massive move. But on the higher time frame, an SFP can be also trend changing, and we could get a whole reversal of uptrend to a downtrend just from an SFP. And also, for example, we have this SFP of these lows from the beginning of the year, and you can see how it wicked down, took out this low, and then closed back above and start ranging. That's why sometimes you see me saying in the chat that's a nice close, and it's because we wick down and we still haven't closed a daily candle below this 27,744 level. And then if you go on the weekly, you can see we haven't closed a weekly candle, and you can see this as an SFP of these lows, because we haven't closed any candles below these lows. So that's why the closes are important, especially on the higher time frame. So now that we talked about where does it occur, let's talk about why does it occur. So imagine you are a larger player or an entity or a group, and you want to fill a big position, let's say 10 million. You have few options on how you can do that. So the first option obviously is pressing market buy, right? Let's say the position is a long position, and the first option is market buy. Obviously there will be big market fees for that position. On 10 million you can calculate it's a big market fee. But then again, you still have the problem of slippage. So let's say you enter a position of 10 million right here on 29,413, and when you press market buy, that 10 million won't immediately be in position, but slowly get filled one by one. And while your position gets filled, even though it's a market, because it's such a big position, it won't get filled in one press, and you still need to wait for that order to get filled. And while it gets filled, you have this slippage and price goes up, and you have obviously your market fees. And even though you've entered here at 29,413, as we said, your average entry might be here around 30k, because of lack of liquidity and slippage, and that's obviously not optimal. The other way of entering your trade would be limit orders. And let's say you have set your limit orders here to a few limit orders in order to get in position, but then maybe as slowly they get filled, you don't fill all of them, and price moves the way you want them without filling your whole position, and then you're left with like a third or half of your intended position. So that's again not optimal. So how can you get into position? You need obviously a lot of liquidity, and the best provider of liquidity in the market is stop losses, and that's what happens behind these swing failure patterns. They are essentially a stop loss hunt where price goes below a certain high or low, and in that certain high or low we can imagine that there are a lot of stop losses. This happens on the lower time frame as well for day trades, and most times happens on ranges or these setups, for example wedges, head and shoulders, inverse head and shoulders. All of these patterns usually get SFP'd. So in this case, we are trading in a range, as you can see, a pretty well defined range with nice highs, nice lows, and you can see how price here went down, took out all of the stop loss. I mean, we can't say for certainty if all of the stop losses were taken, but a lot of stop losses were taken with this wick to the downside. And that's why I said it happens a lot on ranges. For example, if you are trading this range, and let's say you are long from here, here, or anywhere here, where would be your stop loss? It would be, of course, below this low, right? Before the initial low. And below the initial low. And that's what creates the liquidity for the position sizes for these big entities that trade Bitcoin. And oftentimes you see these wicks to the upside of the ranges, wicks to the downside, and that's just liquidity grabs in order to fill their big positions. And here you can see how price went down, took out all the stop losses, and then went almost 7% to the upside. And this happens a lot in day trades. And it also happens on every asset. It's not just Bitcoin. It happens on altcoins, in the stock market, and pretty much everywhere. So now we will talk about how can we trade it. In order to trade this with order flow, you need the order flow template, which is on the website. And let's go back for this example to show you guys what happened. Even though it's hard to explain what happened, because obviously it's best in the moment to trade this, and it's hard to go back because there will probably be big decrease in open interest. Yeah, you can see this, but I will still show you. I will still um, try and explain what we want to see. So first of all, you mark your level on TradingView. In this case, 28,547. We already talked about why this is an important level. It's low of the range and we expect a lot of stop losses, which means liquidity for the big positions to get filled. So let's hop into order flow and talk about what happened here. So you want all of these enabled. If you don't have them, just import a template or enable these. So open interest, FPBS most importantly, and then I like to have the value area enabled as well, and also direct bubbles to see if there are any liquidations, and most of the time there are. So let's talk first how things happen one by one. First of all, you will have this wick. Depends on like the time frame you're seeing this. I think we spent a couple of minutes there. We did. So you have this big drop in price. All of a sudden, it's a 3% decrease, and then you hop in order flow. You see this big decrease in open interest, and that means a lot of positions got stopped out, and that's what we want, right? This is a stop loss, remember, stop loss hunt for the big positions to get filled. So we see this big decrease in open interest, a lot of stop losses getting hit, and then you go to the FPBS, you see the delta, which is negative 37 million. And you may be wondering why is it negative. It's because for a long position your stop loss is a market short, right? And when your market short gets hit, it's a negative delta. And you can see that negative 37 million, so 37 million got stopped out, probably even more because this is just the delta, so it's the difference, and probably more than 37 got stopped out, but this is what I look at, so the delta. And then you go into the value area to see where the most volume has been transacted in this candle. And when trading an SFP, you want it to be at the low of the candle for longs and have the candle for shorts, because you want a lot of volume traded at the low and the top of the candle. So let's zoom in a bit to see the footprint, and then this is what you want to see essentially. So decrease in open interest, you can see you want to see a lot of volume and a lot of delta, and then you really want to see a new short positions opening at the low, essentially getting trapped in this lower wick. So we can see here that in the third candle, 4 million negative delta opened, and we can see that they are new positions because of the increase in open interest, and then we can see they are shorts because the negative 4 million. And then that you want to see that because they are essentially a fuel to the upside later on when you start moving away from their entry. Then you start moving away, and that means they are underwater, and then when they close, that means they will have to market buy, and that's again fuel for more upside. And then what you really want to see is new longs opening with buying imbalances and a lot of volume, and this is exactly what we got here. You can see all of the buying imbalances all are increasing, which means new positions. And then on FPBS we can see 28 million. And then in the lows, if you are on a TR chart, for example, even on this chart you can see we are on the 5 minute, but these 4 million shorts created a bullish divergence. So here, so the CVD was negative 117 million, and then with these 4 million it got to negative 120 million, and those shorts created a bullish divergence and then price went up. Usually you don't have this time with SFPs. There aren't any rules on time with SFPs, just because you can see here we spent a couple of minutes down. On the 5 minute you can't really see that it's a swing failure pattern because you can see we spend a couple of minutes there, um, exactly 30 minutes. But then if you go on the 1 hour, you can see it's a nice wick to the upside and then closes above. In order to confirm a swing failure pattern, this is how you do so. With all of these things I just said, you want to see negative delta at the lows or positive depending on if you're trading a long or short position. And then of course we need the decrease in open interest for the stop loss, and then the buying imbalances. And also, as a confirmation, I use the buying tails on the TPO template. So if there is a buying tail, that means for me that it's a valid SFP, and that's why I oftentimes say wait for a 30-minute close, because this is a 30-minute time frame, um, and the buying tail gets confirmed after a 30-minute close. And yeah, so if you were trading this at in the moment, I would have got in after this CVD divergence, but as I said, we don't get these CVD divergence oftentimes, and the safer in quotation marks entry is to wait for the close. In this example, it would be the 1 hour close. So after it closed here, your long position would look something like this. Then stop loss below the entry, and you target the high of the range, obviously, and you wouldn't have been stopped out here. Or you can wait for a retest, which we got on the 786 here on the 27th of May, the next day. But yeah, the entry really depends on what time frame you're looking at this. So if you were looking at the 5 minute, it's not really an SFP because we had a couple of closes there. But then that's where order flow helps, and that's why I didn't wait for a 1 hour close, because I saw the new shorts there, the CVD divergence, and then I entered afterwards. So let's talk about another local day trade swing failure pattern. I will be talking about this one because I traded it. I was essentially looking at this high to get taken out on the 23rd of May around 8 o'clock my time. And let's hop into order flow and talk you guys through it. So this is when the first week happened. So you can see that it's not really an SFP on the 30-minute, it's more on the 1 hour. But order flow helped me trade this. So you can see I'm on a 5 minute here, on the 1 hour here, and we came up initially, take out this high, and then let and then seeing at the order flow, you can see that we had a decrease in open interest, so some stop losses getting hit. And because those stop losses are for short positions and they are market longs, and that's why you have the positive delta here. So some stop losses getting hit, we see liquidation bubbles, and then the value of the candle is not really at the top, it's kind of in the middle. And you could have entered here, but there aren't trap traders, and that's what we want. As I said, that's like one of the main ingredients for swing failure patterns. So you want decrease in open interest for the stop losses, then increase. That's why it's best to trade this at the moment, and it's kind of hard to look back because I don't know if there was an increase here, if this was a whole decrease. I mean, I know because I traded, but you don't know if you're looking back. So it's best to trade it in the moment. And sometimes you see this big decrease, and then as you are there in the wick, you see an increase and new longs coming in, but then price closes here, and then the open interest bar closes here, and it's still red, but there are some new positions in it, and you can't know if you aren't and there trading it. Hopefully you guys understand what I'm trying to say here. And as I said, we didn't have that many trapped traders here, and there aren't any new shorts opening that I would say are aggressive in trapping the longs here. You can see there's like barely 1 million negative delta, and then this one is a decrease of 3 million negative delta, and then again increase of 1, which is nothing significant. But then we come up for a second time, and this time you can see it ended in a increase in open interest, and then you on the FPBS you see positive delta, so new longs here, and you can zoom in and see 1.3, then 5.8, and that's where I entered. So it essentially, let me go on the 5 minute, it essentially SFP'd the SFP, and we get that oftentimes in recent times. So you have an SFP, and then you SFP the SFP. It usually happens on a larger time frame, but this one happened on the 5 minute, and you can see the later SFP had more longs into it, and then price just declined. Since then, there weren't um, any aggressive shorts at the time, but they entered later. You can see here 1.5 with 12 million volume candle, and that's what you want to see. And then we had like a retest, so you can see we get the retests quite often now. Previously we didn't, and you can see it bounced from the 786 around the 886 here, but then if you zoomed out you could have seen this massive bearish divergence, which again we don't usually get with swing failure pattern trades, but this is like outside the SFP that happened here. It's more like a day trade. You can see how CVD is going up, price is going down, so essentially someone here is absorbing all of these longs, and then it pushed price down for a couple of percent. Let me check exactly how much. For 6.3%. So that's how you trade SFPs. So I wrote basically the essential things. You want decrease in open interest for all the stop losses getting hit. Then you want the new longs and new shorts, depending on if it's a long or short position. And these are for basically the fuel upside. And then you want to see buying or selling imbalances out of the the SFP essentially leaving the traders trapped and then either liquidated or just closing their position. Some other things are that you would want obviously a lot of volume at these lows or highs where SFPs happen. For example, on this low that happened, you can see the volume was 162 million on the 5 minute, and then if you go on the 15 minute, it's 203 million, and then you can see all of the increases of open interest out of it with the buying imbalances. So you want volume and also direct bubbles. That's like confirmations that you want. That's like an extra confirmation that big positions get liquidated. Maybe it was a hunt for liquidation, and we can see these on the retest as well. And also, it's important not too long while this is happening, or I wouldn't have set limit orders because um, so for this SFP, obviously we had support like the golden pocket below it, and you could have set limit orders there if you are a limit order guy. I usually don't enter with limit orders, but SFPs usually don't have any support above or below them, and if you had set limit orders there, it's essentially like either like knife catching, and you successfully catch the knife and you go to the upside, or you are underwater immediately. And if you had set like limit orders here and price didn't SFP it, you would have been underwater immediately after it, after your limits get filled. And same goes for the upside. We don't have, for example, if you are looking to trade this SFP, we don't have like a golden pocket above it, and if you have limit orders, price can just easily do this and you will be underwater. And that's why SFPs you shouldn't trade with limit orders. Maybe you can trade other setups, but SFPs are um, dangerous to trade with limit orders. And also don't rush it. If you're looking at this and then you don't have any confirmations, just wait it out. Maybe you see like increase in maybe you see an increase in open interest here, and then you can see that they are new shorts, but until they get trapped is actually bearish, and it's like a breakout of the range. So until they get trapped, you shouldn't enter. That's why I said like wait for the closes. For local, you would like want a 3 minute close, or if it's a clear SFP, you can enter it after a 5 minute close, and then just go on order flow template, see if there are trap traders there in the wick, and then enter. But if you enter on new shorts opening, it's like very dangerous and it's bearish, so those shorts might not get trapped and you're basically longing into sign of weakness or sign of strength for the downside, and again you will be probably underwater pretty quickly. So that's it. I don't think I have anything to add to that. You know what's an SFP now. You know where does it occur, what time frame, and where on the charts. Why does it occur? I have explained that as well. And then how can we trade it? I have explained that as well and have given some examples. I will try and screen record an SFP happening live in the time, and maybe me talking through it and upload it on the course. But I would have to have like like a reminder because I will forget to record. And yeah, that's it. So talk to you guys in the Discord. Bye bye.